All right, let's get started. It's been a week off. You've had a nice, relaxing week? Not. I didn't have a nice, relaxing week. I hope you guys did. I had to go get an upgrade to my back. Get an upgrade. You know what that means? Go to the doctor, have my back looked at. So I've been in recovery, but doing pretty good today, up and walking about and getting ready to get back into the swing of things here. Market's been a little funny, not funny, but pretty much doing what we expected. So I want to jump in, and today we're going to give a few more people here just a chance to join us. We've got a nice little start here, but I want to go through and I want to talk about reinvesting our dividends. We're kind of doing a little bit of a different time today. We generally start at 8 o'clock. We used to start at 7:30 when the market opened, and had too many people say that was too early. I'm like, that's when the market opens. And so we went to 8 o'clock, and then because of my back recovery, I decided to give myself an extra hour. So today is 9 o'clock, and markets have been open for an hour and a half already. So that's hopefully you guys are okay with that. I had to sleep in a little bit, still recovering a little bit from my back surgery. So we're getting back into the swing of things. So I did get a bunch of tail wagging Pavlovian happy hits on Friday, meaning I did get some dividends paid out on Friday. And I have to figure out where we're going to put that money, or even if we're going to put that money into the market, or maybe it'll sit on the sidelines and just collect a little bit of interest while we wait for something better to go into. Are we going to reinvest the dividends? And that's the question we always have. Now, we used to have that question answered once a month, but now Yield Max, Granite Shares, a lot of these funds, they're starting to pay out every week. So we have to go through and we have to figure out whether we want to put this money back in or not. Now, there's going to be a point come here relatively soon where you're going to see me have to pull a bunch of money out of my account one way or the other, because we got taxes coming. It's the end of the year. I have to do a little tax loss harvesting. I have to do a little window dressing. I have to prepare our accounts for next year, right? So we have to set new cost basis on each portfolio and start a new cost basis. Now, if you're in Portfolio Matrix, you don't have to do that because it takes care of it automatically based on where you state your year is. But if you're doing it in a spreadsheet, then you have to state a new cost basis. And so a lot of guys do it that way. A lot of big companies do it that way. That's why you have tax loss harvesting, preparing for taxes so that they can reduce some of their taxes, get rid of some of their ugly trades, which is called window dressing, so that next year their trades look good. So when they show their clients, they don't say, "Hi, look at my trades," and there's one really ugly, glaring black eye on there. Well, this is your opportunity to clean that out of there and get that taken off of your books. Not necessarily the wisest, you're not doing it because it's a profitable thing to do or not a profitable thing to do. You're doing it because it makes your portfolio look better. And that's called window dressing. And so they do that all the time too. You can do it too. You can make your portfolio look a little bit better. I've got a one that I want to do a little window dressing on. I'll show you here. We're going to go in and I'm going to pull up my portfolio, and we're going to see the ones that I've got in my portfolio. So we got to find the ones that says, where's the live, real. Maybe it's not here. UBI, my primary UBI portfolio, live portfolio. I think that's it. I'm going to double check, but I do have one in here that I want to do a little window dressing on. So I'm going to show you that one. I want to just get rid of it because not because it's a lot of money or a little bit of money. It's because I like it. I don't know if I want to get rid of it or not. It's just not very much money, and I bought it at the absolute very worst possible time I possibly ever could have. And so this is that market. Okay, I think this is it. This is Sock. No, this is not. No, is Soxy the one? Let's see. I want to see which one I've got on here. I think it's Chippy. Chippy is the one I'm looking at. Chippy right there. This little guy right here. I'm a little disappointed in my purchase of this guy, but it is what it is. It's just, I got in, admittedly so, right there at that yellow line. Let's get rid of the Fibonacci ruler just to make things Let's get rid of the Donchian channel just to make that simpler. So the only thing I want in there is the 200 period moving average. Now the problem is the 200 period moving average. I turn that on, and well, there's not 200 periods in there, so it's not showing anything. So put the 100 period moving average, and that's all I got for 100 period moving average. So 200 would be down here somewhere, and I bought it up there. That line, that horizontal line, is my entry point. And so that looks really bad because this stock is now making a traditional, I mean, if we take our model that we live off of, right? We live and die off of this little model right here. This is the game we play. So this is our model. So if we take our model, and you guys have seen me do this a million times, they got a new version of Windows and I can't make it work. Do you guys make it work? There we go. Stupid thing. Well, they've decided to get rid of the controls in the upper left side. See that? No. Oh, there it is. Oh, I can't do it. It's really picky, really picky. But there's our model. So we like to see the Elliott Wave pattern coming up to the left. This is the accumulation pattern, right? This is our Wyckoff accumulation distribution model, and I live and die by this little model here. This is what I do everything based on this little model. So what we're seeing is this is the accumulation stage, which if we come back here, we have kind of an accumulation. And then we had this growth stage right through here, which kind of corresponds here. And now this is the little topping formation up in here. This is this little thing here. We're getting this little kind of pattern up in here, it looks like to me. And so we're going to anticipate kind of this pullback or this drawdown into the new accumulation stage. And that's what that looks like to me. It's not the prettiest, and it is based on the yield max fund. And oftentimes say don't use your technical analysis. Don't take it as seriously on the yield max funds as you do on the underlying stock. The problem is this is an index, which is a compilation of a bunch of other stocks. So it's not a single stock ETF. It's just sitting there. Well, it is. I mean, it's just money that's sitting there being used to guarantee their stocks, right? But nonetheless, it looks like to me we got a little bit more downside potential on this thing with a little ABC top formation in here. And although I don't really give a lot of credence to that in these type of funds, it's still making a little bit of noise in there that's what it's doing. So anyway, you can see I'm right here. I couldn't have bought it at the worst possible point. And so yeah, it's let's go look at the spreadsheet and we'll see, because it's probably making money. Maybe it's not. It might be one of my only ones that are losing money. And so I might window dress this one. That's all I'm saying. That's all I'm saying. I might window dress this one. Okay, so let's bring this over. You guys want to see my portfolio, right? So this is my window dressing, Land's World. Okay, so where is Chippy? That's this one, right? Is that the one we said? Yeah, Chippy. Chippy's the one right there. So see, I've only got, get out of there. I hate they put that stupid thing in there, popped up every single time. Hide until reopen this document. I don't want your dumb little icon. All right, Chippy. So I've only got $2,644, which is why I figure I'm gonna window dress this one, because it's down 6% on the NAV and it's down 1% on the yield plus NAV. So it's one of the only ones I'm losing money on. But technically, I bet I'm not, because I think I got a dividend. December 11th. I got a dividend, and so I have to come down here to Chippy, and you can see my Chippy dividend right here, Chippy, and that's December. Yep, I got 1772, so I got to come in here and go plus 17.72, and if I do that, oh, I'm still down. That didn't help. I'm still down $15, still down 1% on that one. I'm not making money on it. And you can see out of my list, out of that whole list of all the things that I'm making, I'm losing money on Beatty. I'm losing money on Chippy. And that's the only one I've got losses on. So this is the all-important column right there. This is how much I've made this year. $577,000 this year, or 69% return. That's my portfolio. That's real money. That's not That's not demo simulated money. That's real money. And you can see my bad boys. My bad boys in there are Chippy. Chippy is 1. I'm down 1%. And Beatty, I'm down 23%. Now, that means we should go look at Beatty, right? Because if I take that loss, that could go to my tax loss harvesting, and I could take that $8,000 loss off against my taxes of my $577,000. Because I'm going to have to pay taxes on $577,000. Now, how am I going to do that? It's going to be very painful, as you can imagine. I'm going to have to, I don't want to take money out of here because that would reduce. If I just went and sold some shares, right? What if I went and sold some shares? That would then lose my income from those shares. So I'm going to have to borrow the money and let the dividends next year pay off this year's taxes. So we'll do that on margin. So we'll go on margin, take the money out on margin, and pay the taxes, and then the dividends for the first probably 3 or 4 months, right? Because you got to pay the government that when you work. That's the nature of the beast, right? You got to pay the government about 3 months worth of labor wages on your taxes. So if that's what you make, then that's what you pay. So whether it's 3 months of your wages on a $30,000 income or 3 months of wages on a $577,000 income, you pay about 3 months worth of your wages goes to the government. So that's about where I'm at, and that's about where it's going to be. So I'm going to have to let the first 3 months of my income go to pay off this year's taxes. So that's where make a lot of money, pay a lot of money. So that's how it works. Okay. It is what it is. I can't sit here and cry over spilt milk. Nobody's feeling sorry for me, right? Nobody's feeling sorry for me. I made $577,000. Now I got to go pay some taxes on it. Nobody's feeling sorry for me. All right. Let's go look over here. And well, I haven't got all of my dividends in there yet. So on Friday, I got my dividends, and I was still laid up in bed. And so I haven't come and put all my dividends into my spreadsheet yet. So I just barely put that one in there for Chippy. So I'm not going to go through and bore you with me putting all of my dividends in to update my spreadsheet. I'll do that after class is over and get that done. So what I want to do is now I want to come over and I want to make that decision on what I'm going to do with my money. How much have I got? I've got about 5, 6. I've got about 6, let's see, 7, 8, 9, almost $10,000 in dividends that have not been put into the spreadsheet and that need to be either reinvested, which I don't need to do. I could just leave them sitting in cash, right? Or I could put some in. So let's go through, and since we got some money, let's go through and see if there's not something we want to put our money into. I do have some options that I have, some option spreads that I have money in right now. So I do still continue to trade on my own. And so I have some options spreads, and there's some things going on with those. So let's come and look at my individual placements on each one of these. Okay, so this is AMD. Now AMDY is what I'm in. This is the 200 period moving average right here. And my entry on AMDY, I thought I had that in there already. AMDY, my average price is $40. So I'm in here at $40. So that means I could put money into AMDY. Where's 40? Down here, 40 even. I'm at $40.03. This is right there. So that's where my average entry price is. So it's down here. It's under the 200 period moving average, and it's underneath my average price. So if I added money in, and look at this down here. This is why didn't that click? There you go. So this is a buy signal right here, but we're getting another drop right here. So this is probably going to go green down here once again. It looks to me like it wants to drop. Let's go look at AMD though. AMD, yeah, see that? It's this little bigger. Let's go ahead and delete all of these drawing tools. And we're going to draw this the other way. We're going to say that this is going to be our ABC in here. I think we're going to get some additional downside potential on the end. This is the underlying. This is AMD. So do I want to put money into AMD right now? Not really. Why? Because it looks like to me that the market's going to flush a little bit more, maybe come down and touch that 200 period moving average, give us an ABC pattern down here at 100, and then maybe we'll get a head and shoulders formation like that. This would be your left shoulder, your neckline. This would be your head, your right shoulder, your neckline, your right shoulder, and then it would be a reversal pattern, right? And we'd anticipate a continuation of the uptrend from there. Now, it could, of course, come down and make a lower low over here. Nothing says the market has to go up, right? So it could come down and make that lower low. And if that's the case, that right shoulder we'd have to grab that whole head and shoulders and move that whole thing down here like this and anticipate another move out here in the future, and that would be a full 3-drive pattern down. But if it just does a 2-drive pattern down, then it would look more something like this. So this would be our 2-drive pattern down. But right now it looks like we're going to come down. So the next quest for this particular stock is to break this low right here. So we're going to see if it's going to break that low, if it's going to hold that low right there to give us that ABC, right? So that's how we would trade this. So the question is, you're going to, if you leave the money out, how much money are you going to put in to AMD? Well, are you going to put the full 10,000? No, of course not. We're going to go over to Portfolio Matrix and let Portfolio Matrix know which one we want to put money in. So we're going to write this down. We like AMD, so we're going to write that down. AMD, take some notes. We're going to put some money into AMDY. So we're going to go ask Portfolio Matrix how much we would put into each one of these, because we don't know, and it makes a big difference on your maximum profit potential based on what you're putting money in. But do we want to put any into this? This is the real question, because it's not below it's not down here, buy low, sell high, right? But you have to take into consideration that you're going to miss a bunch of dividend payments if you stay out of the market. And so again, that comes over to my spreadsheet, which is right here. And that's why I have this section over here. These are my reinvested dividends. So you have to keep these numbers separate. Remember, when you are looking at your dividends, you have to keep your dividends separate from your reinvested dividends, because those are two separate investments and they have separate cost bases, right? So that's why when we start a new portfolio in January, we're going to create a new cost basis, all right? And we're going to come in here, we're going to say, okay, what is our investment going to be in AMD on January 1st, 2026? And we're going to create a new spreadsheet, and we're going to put a new number in there. Now that's going to be blended money, because it's going to be partially our reinvested dividends from last year, and it's also going to be our McDonald's money, what I call McDonald's money, right? Money that we had to go out into the real world and actually trade time for money. And then we put it into the fake world of the financial markets, right? Fake. It's not fake. It's real money. So, but we're not going to have to go trade time for profits, right? We're just going to make money off of the growth of our investments, and we don't have to go trade our time for money. And so we're going to have to create a new cost basis in January, and you're going to watch me do that, because if you're going to subscribe to the channel and stick around and hang out with me, you're going to see me create a new cost basis. And that new cost basis is going to include all this money here, $578,000. And we're going to have to put that in, because I started this year with $540,000 and I made $578,000. So how are we going to do that? Okay, because my NAV I've made $148,000 here in the NAV. So on the net asset growth of my underlying stock, I started with $540,000 in January. I made $148,000, or I'm up 28% on my NAV growth. But then I had dividends of $578,000, which gave me a 69% annualized return. Now, that's not bad. I'm pretty happy with that. All right, pretty darn happy with that. But the difference here is that this is my NAV. This is my net asset growth. So my portfolio grew from $540,000 by $148,000 to $688,000, or 28%. Well, then I reinvested those dividends that I got over here. This is my dividend column over here, right here. I got $429,000 in dividends. So $429,000 in dividends, those are not part of this, right? Because this is the seed money, right? Seed money profit, seed profit and loss only. So I made $148,000 in seed money, or 28%. So now I have to take my reinvestments, and that's why I have another section over here on my spreadsheet. This is my reinvested, capital reinvested. So you can see I reinvested Capital total reinvested 9,301. Capital in reinvested. That's not right. What happened to my? Why is that there? That sum is incorrect. I've been working on this spreadsheet. I got to make sure some of these things are correct. I think that one's still correct. No, that one wasn't correct. Oh my goodness, I've got errors in my spreadsheet. I've added some stuff. Let me run these totals here. Oh, that's not right. Does that go V8 to 21? V21. Yeah, it does. That one's correct. So that's 27%. This is what was not correct, 62,000. That's correct now. Let me just double check this one real quick. No, you silly thing. It goes this way. I got to divide by 0 in my spreadsheet. Let's see what's wrong. That's not right either, Lan. I'm not on any drugs, I promise. I stopped taking them 2 days ago. They gave me some OxyContin. Holy cow. That stuff messed me up. Maybe I'm still got some residual going on in here. That's the one that's divided by 10. Now, what's wrong with that? Auto sum. Why is that not working properly? I got to divide that by 10. Divide by 10. Is it 10? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It is. So this is going to be the same. We got to do this one. Divide. No, we're not dividing that one by 10. If we do, we should have to divide that one by 10 too. Divide that by 10. All right, there we go. So now we got a profit and loss NAV plus dev 72% annualized return. So that's back to normal. Okay, I think we're right now. So we got a capital reinvested. So I've reinvested $262,000 of my dividends. That's what that's telling me. So for a total capital invested of $802,000. So on my $262,000 of reinvested dividends, and I'm going to have to double check this to make sure this is correct as well. Hold on a second. I'm losing my voice. All right. So let's just go with these numbers for now. I'm going to double check them, but I think what we've got going is pretty close. So this is the money I put back in, $230,000. Reinvested $62,000. So I've lost $62,000 of my reinvested current value that I've dripped back in. And I don't really drip. Drip is just meaning that you put the money back in. I don't drip as in just tell the brokerage firm to just put the money right back into the same fund. I always decide where I want to put it. And I use Portfolio Matrix. Nowadays, I didn't used to have that feature. But nowadays I've got Portfolio Matrix, which tells me mathematically calculates the best location to put that money in. So I don't just drip right back into the same thing that I pulled the money out of. So if Tesla gives me a dividend, I don't just shove it right back into Tesla. That's not a good thing to do. Don't do that. So you have to get that money, and then you have to decide strategically where the best places to invest that money is. Because you have to also make that decision that if you leave it sitting on the sideline, you're not going to get the dividends, right? So you say, well, if I put it into the market, it's not buying low, it's not bringing my dollar cost average in, I'm buying high. Is it still making me money? So you have to take that into consideration that on the dividends, you don't have a cost basis. You have a zero cost basis, basically free money, right? I mean, when you get a dividend off of, let's say you put $50,000 into a fund and you went to McDonald's and you earned that $50,000 and you worked for a whole, 3 years to get it. Now you take that 50 grand that you've been saving your whole life for, your whole career, and you put it into the stock market. Well, that's your $50,000 is your McDonald's money. That's your cost basis. But when you get your first dividend, it comes in, let's say you get, $1,000 in dividends the first month. Well, that has no cost basis. It's free money. So you can't just take that $1,000 and add it back into your $30,000 and say, now I have $31,000 of investment, because the $31,000 would not be a true representation of your exponential compounded growth, right? And we know that exponential compounded growth, as I always say, is one of the 7 wonders of the world. But just compounded growth is pretty cool. We love it. We can't, not dissing compounded growth. That's really cool, but it's not exponential compounded growth. All right. So you're getting compounded growth is a lot of money, but exponential compounded growth is a tremendous amount of money. In fact, it's such a big amount of money, it's almost ridiculous when you have a zero cost basis on your money, how fast that stuff grows. And then when that gets dividends, so you have a money that has no cost basis, and then you get more money from the money that has no cost basis, and you make more money on that money. Can you see how fast that snowball begins to grow with no cost basis? It's all free money. That's your exponential compounded growth. And so that's why you can have something like this over here on AMDY, where I've got a 418% return on money because I got no compounded, it's all free money growing over here. I got no cost basis to it. And that's what I'm trying to do with this little spreadsheet over here. So this keeps my reinvestment separate from my McDonald's money. So this calculates all my McDonald's money, my NAV, my dividends, my growth. This is my compounded growth over here. This is my exponential compounded growth over here. That's what I'm trying to keep track of here. It's kind of difficult, not going to lie to you. Keeping a spreadsheet like this is kind of hard to keep your brain straight with all this stuff, all right? Because you have to know which dividends you're counting with a cost basis and which ones you're not. And so I've got over here current value. This is my drip money, or the money I put back in. So I put 230,000 back in. You can see down here I pulled 107,000 out, and this is the money that I pulled out to develop Portfolio Matrix with, right? So that's what we've done. We wanted to, when my son and I got together, we said, let's develop Portfolio Matrix. And mostly we wanted to do it for ourselves, so we didn't have to do these big crazy spreadsheets. We do Portfolio Matrix, we're going to build it. But our goal was to make the income from our investments pay for the software that we're using to track our investments. Pretty cool, right? So Portfolio Matrix has 100% been developed using the strategies and tools that Portfolio Matrix tracks. So the type of trading that Portfolio Matrix does was completely, all the development costs of Portfolio Matrix was paid for from investments that we made, that we used Portfolio Matrix to track and trade, right? Pretty cool, right? So all this money, this is the money that's been pulled out of this account, and this is what we've used to develop Portfolio Matrix with. And so that's where that money's gone for the most part, most of this. I did take some out and spend it on some bills and things that I had, but not very much, like $5,000. The rest of that, so you could say basically $100,000 has been taken out and put into Portfolio Matrix development. So that's what it's cost us so far to develop Portfolio Matrix. Actually, a little more than that, because yeah, it's a little more than that, because this is just what's been pulled out of this account right here, and then we got multiple accounts. So but that was the goal. The goal was to have Portfolio Matrix developed by money that Portfolio Matrix teaches you to track and make. So this is the how much money I've put in. So 230,000, and I've lost $62,000 that money. Now this one here, AMD says I've made 384% on that because I got no cost basis on this. See, I'm still working on this. I'm not exactly sure I've got this right, but I've got 230,000, 62,000. The thing is this, I want to take this off. Why have I got that in there? At this, and I've got a reinvested profit loss of $5,000. That's why. All the rest of these lost money. That's the only one that made me money. So AMDY actually made me $5,000 on a $7,000 in total capital investment, $11,000 investment. We dripped in 7,000 of that, making me 5,000. A 384% return is just stupid money. That's your exponential compounded growth. So that's making me have a 27% return. But if you look at all the rest, they're all down. They're all losers. So every single one of the markets that I put reinvested my dividends. So you think about, oh, I got dividends, I'm going to reinvest them, I'm going to reinvest them, I'm going to reinvest them. For this whole year, the net asset value of my reinvestment dividends has been negative, except for that one right there. And it's given me $62,000 in losses. So all of my reinvested dividends has lost $62,000. I haven't made anything on it. But I did get dividends on it. So the dividends that I received were $10,000 a month, or $129,000. So although I lost $62,000 on the dividends themselves, on the net asset value of the dividends that I put in, I got dividends on that income, and I've made $129,000. So when you subtract the loss of 62, and where am I doing that? I got to subtract 62 from the dividends, annual dividends monthly. I think, oh, it's over here. Oh, that's just a percentage. I think I'm missing a column in here. I think I talked about this last time. I said I'm missing a column. There's where I'm missing my column. Profit and loss. I'm missing a column that shows me the dollar amount. So I actually ended up making 72,000. So I need to take 129 minus 62, which will give me a column here, will give me a dollar amount. I'm not going to do that right now. I'll waste your time. But that's the point that I'm trying to make over here, is that we're tracking our dividends separately. And even though my dividends on the net asset value of the reinvestment lost money of $62,000, the dividends on those dividends, the exponential compounded growth, still gave me $129,000 in profit. $10,000 a month. Yeah, I'm missing a column in here. I need to subtract 62,000 from 129 to give me my total dollar amount. So my dividends was 45%. Total NAV, well, that's a percent. I don't know if I'm doing that right, because I don't have the dollar amount. Well, I do. It's right there. This one minus this one. So, oh, that's just summing this up. So what is this doing? Y20 plus V20. V20. Oh, it's still just doing, well, it's correct because it's doing the percentage. I just don't have the column that shows the dollar amount. So take 129 minus 62, and that would be my dollar amount, which ends up being a 72% annualized return on my dividends, So the dividends that I reinvested, I made 72% annualized return on them. Even though I lost $62,000 on the net asset value, I made $129,000 on the dividends. See how that's calculated? Very strange, but that's how you do it. And I used to do it wrong, and I've learned that I got ChatGPT to help me and tell me that I'm doing it wrong, and then I did it right. So that's what I'm doing. I've still got and I promised that I was going to give you guys this spreadsheet for those of you who are interested in having the spreadsheet. And I still have a bug in it. So it'll come out with the Pit News Magazine. You guys who have Pit News Magazine will get a link to this spreadsheet in the January issue, when the January issue drops. Okay, so that's what that is. So now I have to decide. Now, this circles all the way back around to what we were talking about. Am I going to take the dividends that I have, currently $10,000 sitting in cash, right? I have $10,000 sitting in cash. Am I going to take that and reinvest it into something, knowing that there's a possibility that the NAV could lose money, but I will make money on the reinvested dividends side? I don't want to lose money on the NAV. I want to be better at that. Now that I've got Portfolio Matrix, I think 2026 is going to be a much better year, because the way I've always done it before is I just kind of shot from the hip, right? Oh, I don't know. Let's go put some over here in this one. Oh, I don't know. Let's just go put some of this money over into this one. This looks good. Let's put some here. Oh, this one's, I don't know, put some money over here. Just kind of randomly throwing the money back into the different portfolios, not knowing really mathematically calculated any strategy other than, oh, well, it's below the 200 but none of them were below the 200. We just kept throwing money back in to get the reinvested dividends, which was it worked. I don't want to say that wasn't a good strategy. It still worked out. We still made a lot of money, made 45% return, $129,000, but we did lose 62,000. So my quest in 2026 is to try and do better over here. I want to do better over here. I want to not lose $62,000 of my reinvested, or in this case, 27%. I don't want to lose 20. Well, that's a positive number because of this number here. I wish I could just take that out for now. What if I took that out? What if we did this? We're just going to take that out. I'm going to take that one that shows a 382% return out. We're just going to take it out. And it's got to be divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, divided by 9. Divided by 9. So I lost 13%. Okay, so I lost 13% annualized return on my net asset value of my reinvested dividends. I want to see if I can't not do that. I don't want to lose that 13%. So that's what this is all about. That's what this class is all about. Trying to get to the point to let you guys realize what I'm doing here, and that I don't want to lose $62,000 next year making the same error. Now, again, is it an error? I don't think it's an error. I think it was a lack of judgment because I didn't have the tools that I have now. I got better tools. So will I be able to more logically maybe not lose as much? Because you still have to you still have to say, well, look, man, if you say, well, I'm trying to save 62,000, I'm stepping over pennies, stepping over dollars to pick up pennies, right? I lost 62,000, but I made 129,000 by reinvesting those dividends. So I don't want to not reinvest my dividends, because then I miss out on the 129 to save the 62. And I don't want to do that. That would be a worse mistake, right? That would be a worse mistake. The biggest mistake is not tracking this, so that I don't know what's happening. You got to track this. If you don't track this, you don't know what's going on. You got to track it. All right, so the whole idea now is we have to decide where we're going to put our money. Now, we just want to be more strategic. That's all I'm saying. So let's go be more strategic. Let's go back over here and look at our portfolio. So AMD, and we know that my AMD is below the average price, and it's below the 200. So I could put money in AMD. I think AMD would be a good stock I could put money into, and it would solve that problem. Not necessarily solve it, but it would, in my logical mind right now, the way I'm thinking is it would help me have a better reinvestment. All right. Rather than buying like I did with Chippy, which was right at the very top of the market, way up here. At least I'm below my average price, and I'm pulling that average dollar amount down, and I'm below the 200 period moving average. So I think AMD would be a good one to put it into. But when I look at the underlying AMD, well, technically speaking, this thing has some more downside potential. I think it might come down to this 200 period moving average based on this, and I would lose NAV on it. But if I lose NAV on it, I still get the dividends. So I still think it might be, even because it's in a good zone on my buy zone, I still think I can put money into AMD, which if I waited, I'd get a better entry on my AMD if it comes down here where we anticipate. But I would also miss out on my dividends. And I don't think missing out on dividends is a better plan than holding on or staying out of the market to try and save NAV, because I proved that, right? We proved that. We proved that it's better to be in the market collecting dividends because you get the more money than staying out of the market to save NAV. Right? I think we can agree on that. I think that that's proven out through mathematical history. All right, so let's go back over and look at something else that we might want to choose. So we're going to come in here and let's go to OARKK. Now, ARKK is in the same situation. Let's go look down to OARK. Okay, so I've got some OARK. Let's go see where my average is. I thought I had all these in here, but I must have deleted them accidentally. Okay, so my OARK average. I'm in OARK. So my OARK average value is 4270. So I take 4270. Where's that? 4270. Get as close as I can. And OARK is below the 200 period moving average, and it's below my average price. So I could easily put money into OARK and feel comfortable that this is a good one to put money into. So I'm going to write this one down, OARK, because we're going to take these over into Portfolio Matrix and have Portfolio Matrix tell us where to put that money. But keeping in mind when we come back to ARKK, we're going to go through, and let me just get rid of all this, and I get rid of the Donchian channel, get rid of parabolic sock. No, we'll keep that. I'm just going to make it go like this. There we go. So, so now this is above the 200 period moving average. Oh, well, this is ARKK. But it looks like to me, what does it look like to you guys? Bring our map over. It looks like it's been doing this big long up. It's got this little double top up in here, and it's starting to fall. It's on the first one. This is the first one right here, right? And now it looks like we got one more to go. We could get another drop in here, and it's going red. Now, if it goes green, that could be the bottom. It's bouncing off that. It didn't quite touch the 200, but that's a pretty close bounce. Close enough. You remember when we're trading, it's kind of like horseshoes. Close is good. Close is good. Doesn't have to be exact. Close is good. How come I can't do that? Okay, here we go. So now the question is this going to be our head? And I don't think so. It doesn't look, I mean, that would mean this would have to be the left shoulder up in here, right here. And that doesn't look like a left shoulder to me. I don't think that's going to be what we're going to get. We could. I mean, you know, all we're doing is making our scientific wild ass guess. But that market's coming down. It looks like to me it wants to come down. And if this is the head, we could move this whole thing would have to come down if this ended up breaking that low right there. So again, the game we're playing right now is that low. That's the low we're playing. Because this would then end up with a whole head and shoulders down in here. Come on. Right? Which would be something like this. And we don't know how far this head would come, probably down in here somewhere. So if it breaks and goes and stays above this low point, this left shoulder right here, we could get another rally back up out of this thing, and it could go what I would consider to be early, because this is part of the head reversal formation to the downside. We don't usually make that your left shoulder. Your left shoulder is the first dip, which is down here. We got kind of a funny little double top in here thing, so it could be, you know, your little ABC. I'm sure that there would be some other technical analysts besides me, who would say, no, this is your left shoulder land. This is your head. This is your head. This is your neckline here, your right shoulder. And we're going to anticipate, we're going to take this line up here and we're going to go up and see that. You're going to get analysts that are going to say that. That's where this is at. And they're going to be very bullish on this market. And they're going to say, as soon as this thing breaks these blue lights, might not even break the blue lights. It might take off and go green and go straight up, break the blue lights out here on its way up. But I'm not in that camp right now. I think that's too early of a left shoulder. I think this has got to be the left shoulder down here. We might get one more down. I don't know. But nonetheless, it's not worth staying out of this market to try and capture the smaller NAV compared to what we could get with the dividends. And because OARK is below our 200 period moving average and below our average entry price, we can still add money into this market and feel like it's going to be a good investment. Okay. I'm going to go with that. My scientific wild ass guess based on the best knowledge I have available to me at the time. All right. So our next one is BD. Now, BD, y'all know this is a bad one for me. Let's remove this one. Let's keep that one. BD, I'm losing money on. When we go over to my spreadsheet, you can see that BD is one I've lost. I'm down $14,000 on the NAV. Look, here's another one. Misty, I'm down 27 on the NAV. I'm down 3,000 on OARK on the NAV. I'm down 8,000 on Snowy on the NAV. But the dividends included I'm down 23% combined. So BD is one of the only ones. Remember, BD and Chippy are the only ones I'm losing money on. And BD, I'm losing $8,600 on. $14,000 on the NAV, because I put $37,000 in when I got into it. I put $37,000 in, which was stupid. Why'd you do that, Lan? I don't know. It was an emotional move. So I'm down 14,000 or 40%. And even the NAV is, or the dividends are not keeping up. I'm down 8,000. Well, let's see. P&L on the BD. Where's BD down here? BD right here. So actually, let's see if I'm actually that bad. So if we go over to BD, I did get a dividend on Friday on BD, I think. Did I not? BD's December 5th dividend. So 1659.46, 1668. No, that's already recorded. It's already recorded, so I did not get a dividend on Friday on BD. I wonder when the next dividend will come. Oh, it comes once a month. I only get it once a month. BD's a once a monther. So I've got that one's paid out the entire thing. So this year end is going to end with an $8,000 loss on BD. So let's go look at it. So where am I at? This is one I probably clean out as my window dressing because it looks so bad. Look where I entered on. But the thing is, this is my entry. This is the 200 period moving average. And where's the market currently trading? Way down here. So technically speaking, I should be putting money into this one because it's matching the two. And it's Bitcoin and Ethereum. I don't know why I do this to myself. Lan, you hate cryptocurrency. Why do you keep sticking your toe into cryptocurrency? Last year I made a whole bunch of money in Bitcoin. So, oh, thank you. My dear sweet wife just brought me a tea. So I don't know what to do about BD. I don't know whether to just window dressing that thing, close it at $67,000. So I don't want to do that. It's an $8,000 loss I could write off against my taxes. But it's pulling $37,000 out of the market. I have to roll it somewhere else. Otherwise, the dividends are still, $1,659 in dividends. It makes good dividends. I mean, you can't complain about the dividends. What is the average on that? Average dividends is $3.73. I don't have that set up as a, you know what? That's another column that would be nice to see. What are the dividend averages? I don't have that. So the average dividend price, we need to go look that up on Portfolio Matrix, but it's making me $3.73 per share. Current share price is $49. That's a good dividend. If the market if stupid Bitcoin would just stop sliding, that would probably catch up really fast. I used to calculate on my old spreadsheet on this one, I used to have all of how long I had till break even. Like it would tell me all my break even days, how many months until break even, right? And I don't have that over here in the new spreadsheet, and I kind of miss it now. This spreadsheet just got so complicated. It was just like a nightmare to keep it up. And since I got Portfolio Matrix, I don't need to keep all that stuff. So that's why I went to a simpler spreadsheet. But that doesn't tell a percent. It would be nice to have a column in here, I think, that would tell me the percent dividend gain, because right now it just tells me the gain to do the math. So if BD and Bitcoin would just stop going down, just stop going down, my dividends could catch up and I would be profitable relatively quick, right? I mean, Well, I don't know. It's making me $1,000. It's making me $1,000. How much are my dividends monthly? Right here, 1,600 BD. It's making me around $1,600 a month, and I'm down 14,000. So it'd take me about 7 months just to break even with the dividends if the market would just stop right there and stop losing NAV. Well, I'm down to 8,000. So 8,000 divided by 1450, or yeah, 1,600. 1,600. So 8,000 divided by 1,600. Well, I would be back to break even in about 3 months if the market would just stop falling. But it's not stopping falling. Bitcoin's still going down. But I've got a lot of guys that I really believe and trust and look to help me, make my scientific wild ass guesses on the fundamentals of Bitcoin. And people are kind of saying that Bitcoin's going to have a good year in 2026. So it doesn't even have to have a good year. It just needs to stop going down. Just stop going down, and it would have a good year for me. Just because you're getting $1,600 a month, so it'd take me about 3 months to catch up. I don't know whether I should sell that thing or not. It makes such a good dividend. What do you guys think? You think we ought to dump that one? I don't know if there's something else we can find that we could put it into that might return a higher dividend return. We're going to have to go do some research on that too. If there's something else we could roll that money into. There's Bido. Bido's the same thing. I'm not going to even entertain Bido because it's the exact same thing as BD. It's another one of these stupid cryptos. Although I'm making money on it, I'm up $49,000, so I can't complain about Bido. I'm making a lot of money on Bido so far this year, but the last 3 months have not been very good, right? So we put 35,000 in. On the NAV, we made 65,000. We're up 30,000 on the. I can't complain about Bido, but I've held Bido for a long time, so I have a low cost basis on it. But it's the exact same thing as BD. It's like BD and Bido. Lane, you got way too much money in these stupid cryptos. I know. But I made so much money from it last year. I'm giving it all back this year. All right, there's Chippy. Let's go. We already looked at Chippy. Chippy, I've only got $2,600 into it. So I think I'm going to window dressing that one. I think I'm just going to pull that one off and roll the money. But I want Chippy. I like Chippy. Chippy's one of the target 12, isn't it? I think it is. I think Chippy's one of the target 12. So they're trying to maintain a 12% annualized dividend return and then let the growth be whatever it is. And it's been growing. Chippy is, a whole bunch of semiconductors, and we love semiconductor markets. That's with AI and everything, semiconductors are good. We're just getting a little blow off right here at the top right now. Little profit taking, nothing wrong with that. You want to see who's in it? Let's go look and see who's in it. Chippy is a, and I'll tell you, I'm not real fond of, you can look at my portfolio and you can see I'm not real fond of being in these diversified funds. I don't have any, or very few. I don't have Ulti. I don't have Biggie. I don't have any of these diversified funds. Chippy is one of the only ones I have, which is a diversified fund. Well, OARK is kind of a diversified fund because ARKK is a diversified portfolio. So you have OARK, which is not diversified because it's on the only thing in it's ARKK, but ARKK itself is a diversified fund. So that's kind of a weird one. So when we come back over to, what was I going to do? Now I lost my train of thought on that one. We're going to go and look and see what Chippy's got in it, weren't we? So let's go over to, I got to pull it up. I don't even have that one up. Where did it go? Oh, keeps popping in and popping out. What? What's going on? What's wrong? That's weird. That's Chrome. No, that's Firefox. Where did Firefox go? It keeps dying on me. Watch. Firefox crashes. Oh, there it is. Okay. All right. No, Firefox. You can't do that. Wow. I love Firefox. Now it's just screwed up. Oh. Go over to FinViz. and we were going to look at CHPY, right? And we're going to see what's in here. So we were going to go and see what they're investing in with this semiconductor. Now that you can see their dividends are coming in every week, and they're paying 39 cents for every share you have, and shares cost $56. So let's see what's in it. See, they got a whole bunch. Let's see, show all. So we got Broadcom, NVIDIA, Micron, Lam Research, Qualcomm, AMD, KLA, Taiwan Semiconductors, Applied Materials, Intel, ACM Research, Analog, ASML, Lattice, Monolithic Power Systems, Microchip, On Semiconductors, Marvel Technologies, Texas Instruments, and NXP Semiconductors. So you can see we got a lot of semiconductors. It looks like Broadcom is their biggest and NVIDIA is second, Micron, and then the rest are about equal. Broadcom, they like Broadcom. Look at Broadcom's dropping like a rock. They got a lot of Broadcom, and it's popping way back right now. So that's what's in that chippy, and I've got a real bad. Oh look, it came up twice after all. Which one are you going to keep, Lan? Avco or Chippy? AMD. This is the one that. Oh, this is the one I want to keep. Let's close this one. Okay. All right. All right, that's what we got. So that's Chippy, and it's flushing out, and I got the worst entry on it. Look at this. Okay, enough of that. Okay, the next one we want to look at is Coinbase. Coin. Oh, this is another. I don't want to look at Coin. Why, Lan? Why don't you want to look at Coin? Because it's another stupid. It's another stupid cryptocurrency. It's based on cryptocurrency. And cryptocurrency is dying right now. So it's dying too. And we got to look at this 3-drive pattern here. We got drive 1, counter trend, drive 2, counter trend. We're going into a third drive down. There's a break in here. But where are we at in Coney? Coney, let's get rid of the Donchian channel again. Moving average, parabolic SAR, and why have we got all these down here? I was drawing all kinds of pictures, it looks like. Okay, so where's our average price on Coney? Let's go look. Average price of Coney. Would Coney be a good one to put some of our money into, reinvest? Coney. My average price on Coney. What's your average price on Coney? Mine is $63.55. So I'm right, $63.55. So that's my average price of Coney. So Coney is way below these stupid. All of these stupid cryptocurrencies, which I hate anyway, are all at the buy zones. Buy. Buy cryptocurrency. It's all way down low. It's going to go up, I promise. It's going to go to the moon. Bitcoin's going to be $1 million by the end of the year. Pays good dividends. Do you want to sacrifice dividends? You want to step over some dollars to pick up some dimes? I don't know. What are we doing with Coney? Coney. Reinvested 20 grand. Value, current value is 3,000. Profit and loss, we lost 1,500. Down 30%. Dividends, 2,800 for a 57% or a 26% overall return. We're making money. We're making money on Coney. And it's in a place where you could put money in. I'm up 26% on the reinvested dividends. And it's fallen like a rock. Well, it's not fallen that far up for me. It's just below my 63.20. This is where it was, right? So even as it fell all the way down here, I still was above my entry point. So my entry point is here. So I'm not really losing all that much on the NAV, and I'm making it up. The dividends are paying for the loss, especially when a market does this, just go sideways. That's what we want to see. We don't like this. We don't like this. Nobody likes that. When it does this, those of us who are dividend investors, yield first. Oh, that's beautiful. We don't have a problem with that. We'd much rather see this, of course. Yeah, green, that's good. Green is good. Red is bad. But green, red, green, red, green, red, that's not bad for us either. The implied volatility is going to drop, which means the value of the premium that we're collecting on our options is going to fall. So our dividends aren't going to be as big. But at least they're not going down. I mean, at least the NAV's not going down, right? So Coney is actually one we could put money into. You got to put it on your list. You can't not. You got to add it. You got to add it. Coinbase. Put money into Coinbase. I don't want to. We're going to go see what Portfolio Matrix says we should do. And you know what? Hood is the same thing. Hood is basically making these big runs because of they're basically the same thing as Coney. Only Hood does stocks, Coney doesn't. Coney only does currencies, cryptocurrencies. That's the only. They're like a brokerage firm. They're like a clearing brokerage firm for cryptocurrency. That's what they do. And so Hood does that also, right? It's Robinhood, but Robinhood, of course, also does stocks, and they also do futures now. You can trade futures on Robinhood. Nobody does, but you can. So you got futures on Robinhood, you got cryptocurrency on Robinhood, and you've got stock market on Robinhood. They even do, they have a very limited offering for tax funds like IRAs and stuff. They don't let you do a lot of this the tax portfolio stuff. You have to do that elsewhere. Like if you want an HSA or something, you can't do that through Robinhood. You have to go somewhere else, like Fidelity or somebody. But Robinhood does crypto, and that's why they had this big, huge, massive run, because the crypto run. But now it's all given back, right? Everybody's giving back. Everybody's giving back. So the question is, are we good putting money into? It's coming down. I mean, drive 1, drive 2, right? We got a little topping formation. I think this is drive 1. We don't want to call this a drive 1. We don't call that a drive because that's your little double top, right? So when you come and look at this, you don't call this you don't call this between this point and this point. You don't call that a drive. That's not drive 1 up there. This is drive 1 here. And this is drive 2 here. So this is drive 1 here, not up there. That's not drive 1. That's still this topping formation up in here. That's your double top. So I got our little ABC top formation or double top formation up in there. And now we got drive 1. So this is just a counter trend to drive 2. And so we got drive 2 coming in here, which will go off of this one here to here. Actually, no, we want to go from here, the C point, here to there. All right, so that brings us down to let's get rid of the Dawn Chain channel again. That brings us down to that 200 period moving average. And where's our average price on Hood? Now this is Hood. So Hoy is where our, see, my average price on Hoy is way up there. Let's get rid of Dawn Chain channel again. And where, delete all arrows, delete all line tools. Where, that's my average price, way up there. Wasn't bad. I started getting in back in here, I think, actually. Back in here. How are we doing on this one? Let's go look at our spreadsheet. This is going to bring up, so Hood, I made 3,000, lost 3,000, lost 24, up 20. I'm down 4%. Hood on my reinvested dividends, I'm down 4%. It's because I got a bad entry, right? And I've reinvested, total capital invested is 46,000. What about over here on this one? Hood, hui. 30,000 is what my original investment. Current value, NAV only 35,000. So it's gone up 5,000. So I made 19% return on my original $30,000 investment. And then dividends, I've received $9,000 in dividends. So a dividend plus NAV is 15,000. So far this year, I made 15,000 or 50% annualized return. But on all the money that I reinvested, all my reinvested dividends, 16,000, 46,000, lost 3,000 on the NAV, and I'm up 3,000 on the dividend. I'm just right there, almost, -4, losing money, breaking even. Have I counted my dividends for this December on this one? I don't think I have. Did we get any? Let's go look and see. Hood. Did you guys get dividends on Hood on Friday? Shareholder related history. Hood market buy. Oh, sell. Hood limit. Where in the heck did all my dividends go? Show more. Older, past 30 days. I don't want past 30 days. I want to know what oh, this is the wrong one. You dummy. Hood. You're not on Hood. You're on Hoy. Hoy. So Hoy. There it is. December 12th. Let's go look and see if I added my dividends in for December 12th on Hoy. Hoy. Is that this one? Yep, right there. 1,400. 924.59. Nope, I got to add one in there. Plus 525. 525. That was a small 0.68. That was small, huh? Oh well. The first one was 516. Last one was 924, which was nice. And this one was only 525 again. So if I add that in, what does that do to our numbers over here? Does Hoy become profitable? Hoy. Still 4%. Not enough. Not enough money to change the numbers. So I'm still down 4%, roughly 4% on that. Dividends, annual dividends, monthly dividends are averaging 262. That's not. I don't think that's right. Oh, that's just on this amount here. So it wasn't enough to change. $500 didn't change my numbers. I lost 24% on Hoy. I made 20% here, so that's why I'm down 4%. Do we want to add more into Hoy? So what am I don't know. That's Hoy. I don't want to look at Hoy for that. This is where I think Hoy is going to come. I think we got some downside potential on Hoy. The question is, on Hoy, I'm in the buy zone. Where's chart overlay moving averages? Oh, problem is moving averages. We don't have long enough. Let's go 100. See, 100 is way up there. So we're down here probably around the 200 period moving average. So I'm down. That's the 100. We don't have enough time to do a 200 period moving average. We're getting another green right here. It's breaking the drive 1, drive 2. We're headed into a third drive right here. This is going to probably end up being head and shoulders formation. So this is your left shoulder. This is your neckline. We come down here, get the head down in here, and I think this is where we'll get the turnaround. And we'll get the 3 drives down, right? Drive 1, drive 2, drive 3. And that's where we'll get our turnaround. It looks like the big point here is to break this line right there. Is it going to break that? Is it going to stay above it and turn around and head up from there? Or is it going to come down and break it, give us a new head down here? I bet it breaks it and gives us a new head down here. And so if that's the case, but still on Hoy, well, we're doing the math on the Hoy, which is really not what we should be doing. It's over here that we should be doing the. I think it's going to, do we think it's going to break this line? That's the question. That's the 200 period moving average, because we need to do the math on Hood. So, oh, we don't count that as first drive. This is drive 1. We're coming in with drive 2. I think we'll break it. I think we'll break it, and I think that'll be our head and shoulders right there. Right there. And we get a right shoulder, might even still be below our average price. See that? That's going to come up there, and so that means that line will probably be up in here somewhere. Making a swag, scientific wild ass guess, but I think we got more downside potential, and that's our average. Oh no, that's the breaking of this low point. We don't have an average price on this. This is Hood. So Hoy's, we could put money in Hoy. We could. We're going to put Hoy into our list. Yeah, we got to put it in there. MSTR is going to be one that they're going to say put money into, but I don't even want to talk about this one. This is so stupid. Len, you have to talk about your bad ones. I know. Misty. $80,000 in Misty. It's currently only valued at $52,000. I've lost $27,000 or 34% of my NAV. I know. Dividends, though, have been $94,000. So NAV plus dividends is still a $66,000 profit. I'm up 84% on it. I can't complain. Even though I'm going to, because I hate this. I hate how Misty is. Look at this. It's down, 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 and it's breaking the blue light, so it's going again. It's making another drop. Now we got this line right here. Where's the line in the sand? It's right there. If it breaks that, I'm going to start to cry. I don't want JP Morgan Chase to win. He's the one driving this thing down. He hates MSTR, and he's having a war. All right. What are you doing on this side over here, Lan? MSTR. So capital reinvested, we've reinvested 30,000. Total capital invested 110. So current value drip, we put 35,000 in, reinvested, profit and loss, we're up 5,000. So we can't even complain about that. So for a total, we're up 42% on our reinvested dividends. So we're still making money over here too. But it's only because we got such a good entry over here and had made so much money on it in the first place. But we're just giving it all back. We're down $27,000 right there on that money. And all this money just has no cost basis, so that's why it's still doing okay. But we got such big dividends, $94,000 in dividends. I mean, that thing can go straight down, and with the dividends, it can still give you money. I mean, it's just crazy. Crazy, right? All right, I don't want to put any more in there, but it says you can. We could put it in. We could put it in there. MSTY. Buy when there's blood in the street. Man, I'm telling you, it's bloody. It's bloody Misty. So we put down MSTY and put that into our portfolio. Okay. Well, it is. It is. That doesn't look right. That doesn't look right. Oh, that's got the split in it. We got to just reload our data, and then the split would be gone. I'm not going to do that right now. I have to close the software and open it back up. NVIDIA. Oh, look, we got a call option on here. This is just when we were learning call options. We just stuck one on there for demonstration. Yeah, we think this one's coming down into these red these red circles. That's what that's telling us. The NVIDIA is coming down into the red circles. It's got a nice little head and shoulders up there. This little head and shoulders ended up right there. NVIDIA's coming down, guys. NVIDIA's coming down. So if we go look at NVDY, which is where we got our money, here's our 200 period moving average. Here's our average price. We could definitely be putting money into NVIDIA. It's got more downside potential here. And your dividends, let's go see how we've done with NVIDIA. We put 50,000 in. Current value is at 78,000. So we're making 28,000 or 56% just on our NAV. Our net asset value growth has been 28,000 on NVIDIA. So we've done really well on that one. One of our better ones, I would say. Yeah, for sure. And then grand total dividends, it's given us $35,000 in dividends for a total of NAV plus dividends of 63,000 or 127% annualized return this year so far. So that's one of our very best ones. NVIDIA over here, we've reinvested. Capital invested 90,000. Capital invested 40,000, 90,000. So value, we put 34,000 back in for a $5,000 loss on our reinvestments. So on the NAV of our reinvestments, we put in 34,000. It's gone down 5,000, but we sacrificed 5,000 to get 17,000 in dividends, which worked out for us to be a 44% return. Or if you subtract those two together, it's a 30% annualized return. So we've done good on the NVIDIA. The question is, do you want to sacrifice some more NAV because we know it's going to go down to pick up some additional dividends? So even if this thing comes down, which I think it's going to do, I think it's going to break these lows. It's going to come down into these Fibonacci sweet spots. May not. I mean, you know, if you look at this, it's got one big long sideways narrow channel that it just broke out the top of, but that's kind of where it likes to stay. It likes that price level right there. It popped out the top for a minute and then just come right back down into it. Does it mean it's going to pop out the bottom and come back up into it? Possibly. I think it will. This is the 200 period moving average right here, coming right up through the circle of the Fibonacci sweet spot. Get rid of Donchian channel, too many lines. I think we got some downside right in here. See where that's coming down towards and that's coming up to meet. I think you're going to meet in the middle, right in there. So we got some downside on the NVIDIA. We can definitely put some money into it though, can't we? Because NVIDIA is way below our entry and it's below the 200. So we could sacrifice from some NAV to pick up some. We could sacrifice some NAV. We know we're going to lose some NAV if we put some money in here right now. But we'll pick up the dividends. But it will also bring down our dollar cost average. So we're going to put NVIDIA in here, NVDY. We can put some money into NVIDIA. We've only got a couple left to go, guys. Only a couple left to go. Palantir. We'll go a little faster. Palantir. Wow, what a stock. Look at that baby. Rock and roll. Oh, we need that, don't we? Let's put that one back on here. I've been taking Donchian channel off, but that one I think is a good one. It's right there, dead center. I don't know. Look, this is kind of our little spot down in here. And it's got an ABC. That could be an ABC up in here. Now, the blue light's not quite there yet. It might have a little push higher. And it could be a little double top up in here. Uh-oh. Uh-oh. Is that this? And then we're going to get this. We're buying really high on this one. The problem is it just keeps going up. We keep buying high on this one. It keeps dragging our dollar cost average up higher and higher and higher. Well, this is Palantir. We need to go look at PLT. No, we don't. We need to look at this one. Let's go look at PLTY. Where's our average price? Oh, look, we're below the 200 period moving average. Now we can turn off Donchian channel. We're below the 200 period moving average. We're below the average price. So if we bought it, we'd pull our average price down. So we're okay to buy here. We don't want to buy above the average price. It pulls our average price up. We don't want to buy above the 200 period moving average. It's not good. We want to buy when it's in a dip. Well, this is PLTY, but we don't. We could do that. We could do that if we think it's going to be over here. Problem is, I think it's going to flush. We're going to have to, again, we're going to sacrifice some reinvested NAV growth to pick up the dividends. And are we okay with that? I think we are. Because we've done it successfully over here a number of times. PLTY, 67,000 in capital reinvested for a total investment of 147,000. We've dripped in 60,000. Reinvested profit and loss, we're down 6,000. So there you go. You're sacrificing your net asset value, which we've done. We lost 10% to pick up 33%, 33,000. So we lost 6,000 for a gain of 33,000. I need that other column that tells us that we got to have 33,000 minus 6,000 in a column right here. And that gives us 49,000. Or NAV plus dividend, we're still up 39,000. You can't, 39%. You can't complain about making 39%, even though we've lost 6,000 on the NAV because we made 30,000, 33,000 on the dividends. Sorry, Kirk. I see your frustration. I've not had a real schedule. I had to take last week off because I had an operation on my back. And so I'm kind of in recovery right now, and it's the holidays. And I've been doing everything based around the schedule of my university classes. So these are labs for my university classes. And so I've been having the classes based around when the classes dropped. So the classes were, some of them were taught Tuesdays and Thursdays, some were taught Monday, Wednesday, Friday. And so I've been doing the labs the next day, the following day. And then depending on what the subject was that we were teaching at the university, that's what I've been doing. So I apologize for not having a good, solid, strict schedule. And it's still going to be kind of funny going through the holidays. I don't know what the holidays are going to bring. My wife has ideas that we're going to actually do some sort of vacation. Vacations. I hate vacations. So that means we're going to probably miss a couple other. I don't know what my schedule is going to be. I apologize. All I can say is subscribe to the channel and ring the little bell so that you get notified when we're going to do another live. I don't know. I don't know when it's going to be. It has a lot to do with how I'm feeling. I'm feeling pretty good right now. Last week, I felt like I was coming out of the depths of hell. I thought that I was going to die. They took all the guns and the knives out of the house. hit him. Just kidding. Wasn't that bad. Well, almost. I mean, it was really bad. I mean, I was in such major pain. There's only one other time that I have experienced that kind of pain. What I went through last week was the second most painful thing in my entire life. The most painful thing was when I died. Most of you know I had a heart attack out of the airport. And I died out of the airport. I was dead for half an hour before the paramedics took me to the hospital. They were able to bring me back. But that dying was more painful, but only by about that much. I thought I was going to die last week. It was really painful. So I'm kind of going through a recovery stage right now, but I'm feeling pretty good right now. I went for a walk yesterday. And so kind of taking it easy just through the holidays. Where do we get to? We got to Palantir. So I apologize for. Kirk says he's experienced the same thing on a pain scale of 1 to 10. He's had 17. I was thinking about that myself, Kirk, because you go into the doctor, and I got a pain doctor, and that's who worked on my back for me, right? And you go in there, and he's got a little scale on the wall. He says, "What is your pain?" And he's got all these little frowny faces, right? 0 to 10. And I'm like, well, since your scale only goes to 10, it's like a stochastics indicator, right? It's limited at 10. But the stochastics indicator is limited at 10, but the market can go higher than 10. Actually limited at 100, right? So he asked me what my pain was, and I said, well, it's a 10. And he's like, okay. And then like 2 days later, he calls back and he's like, "What you're paying?" I'm like, "Well, it's about half of what it was last time you asked, but it's still 10." Because last time was 10, and now this is a new 10. This is still 10. It's just not as bad as it was two days ago. So I get your pain there. I understand where you're going. A scale of 17 on a scale of 1 to 10, you can still have a 17. This is what we call exponential compounded pain, right? Exponential compounded pain. So hopefully you're feeling better. They gave me some big, nasty drugs to knock me out, and it made it worse, actually. I got sick, nauseated, wanted to throw up. And when you're in so much pain, your body is just like, and then you have to cough or throw up. Oh man, let's not talk about it anymore. That's disgusting. It's so much pain. Just bad news. Hopefully it solved the problem though, and my back starts feeling better. That's the whole point, right? You go through the nasty so that you can have the good. All right. So we got Palantir we're making money on. Can we go put money into Palantir? That's the question. Palantir. PLTY. We can put, my portfolio says I can put money into Palantir. I don't know if yours does. Depends on where your average entry price is, but mine says PLTY is okay for me to put money into. So I'm going to write that one down. Let's go. We'll try and go a little faster here. Snow and Snowy. Ugh. Look at this thing. I'm not putting money back in. I don't know. When there's blood in the street, put the money in, right? Snowy. I put 60,000 in, 50. I'm down 8,000 on the NAV, 14% loss. But on the dividend side, I got 25,000. So I'm up 17,000 on stupid Snowy, making 28%. Okay, let's come over and see how our Snowy dividends are doing. Snowy. We've only reinvested 50. Oh, capital reinvested. So for a total capital of 65, I only put 5,000 back in. Current value is 3,900. So I've lost 1,000 on my reinvestments, or I'm down 21%. But I made 2,800 in dividends, so I'm up 57% or 36% annualized. Can't complain. Stop your complaining, Lan. Can you put more money into snow? Yeah, Lan, you can. Snowy. Here's your dollar cost average down here. This is an ABC pattern. You should put more money into Snowy. I don't want to put more money into Snowy, but it'll make you money. You might sacrifice some on the NAV if it continues to fall, but your dividends are so high it's covering the losses. The NAV losses by almost twice. All right. SNOY. I can put some money in Snowy. It's below my average. It's below the 200 period moving average. Soxy, we talked about. Tesla. Oh my gosh, look at Tesla. Taking off and going to the moon. Tesla. Below the 200 period moving average. Man, it's got a big day today. They released a new piece of software, and I've got a Tesla, and it came to me, and I turned it on, and you can now talk to Grok, and you can control your car with Grok. It's so cool. It's so cool. Let's get rid of Don Chin channel for a second. It's still below the 200 period moving average. What's my average cost on? Why is it not in here already? What's my average Tesla? What's your average Tesla? TSLY. Where are you guys in at Tesla? Oh, I'm making money. Wow. Okay. Average cost is $39.23. $39.23. That's about as close as I can get. So I'm making money today. Now I did put some in right in here. I've been putting all through here. I've been adding more money to Tesla, and now it's up good today. So they released their new software. You can now control your car with you can just get in the car, you push a button, you say, "Hey Grok, take me to the closest pancake shop." And it says, "There is a great pancake shop on 1322 West, 300 North, and it is open until 7 o'clock tonight. Would you like me to take you there? I have set up your navigation to take you there." So you hit take me there. You hit the button on the screen, and the car just takes you over to the pancake place. It's crazy. And it's really good too. I mean, it drives like I was driving the other day, and I was just driving myself, driving along in my Tesla. And my wife's like, "Turn it on." I was like, "Turn it on? What do you mean turn on? I'm driving. Turn on the auto drive." She doesn't want me to drive anymore. She likes it better when the auto car's driving. She thinks it drives better than I do. So you hit the button and sit back and listen to music and let it take you to the pancake house. That's how it works. Pretty cool. Okay, so Tesla, we can add money in. I can still add money in. It's above my average price, but my average price is pretty darn good on Tesla. Look at that. I'm way down here at the bottom. And I'm still below the 200 period moving average. So I could add some more money in there and not feel too bad. Let's put it in there. TSLY. Tesla coming up here, breaking all-time new highs. Look at that. Holy cow. I thought we were going to get a little ABC pattern in here. I thought we'd get a little bit more of a pullback, but nope. Okay. TSYY. Tesla also announced they've got down in Austin, they've got cars driving around with this new update that they just put out. They got cars driving around down in Austin with nobody in them. They've been doing robotaxi, and the robotaxis have always had a safety driver, right? Somebody in there to help the car in case something happened. With this new update, they're so confident they don't have any safety drivers in their cars down in their Austin test area anymore. They're completely cars driving around in Austin, nobody in them. That's a big leap forward too. That's probably why it's taken off as well. All right, TSYY. TSYY. This one, again, I don't have this one because I got TSLY instead. TSYY is for people who are doing the Granite Shares version. And so I know we have a lot of students who are using this one. And it's going to be the same. It's going to, depending on where you're at, it's below the 200 period moving average. Where's your average price? I'm sure it's high because it's as low as it's ever been. So you could add more into it, and you're going to probably sacrifice net asset value for your, I don't think I have any math on this one. I did have TSYY for a little while. TSYY, there it is. It pays good. The dividends, I got $6,000 in dividends on it before I went back over into TSL, or took the money and put it into TSLY. I only had it for a few months, made $6,000 on it. Of course, I don't know what my NAV loss was. I didn't record that. I'd have to go back and do the math. It would be over in Portfolio Matrix. We could go look at it if we wanted to. All right, so it's getting a little bump in here too. Ulti. I don't have Ulti either. I don't do Ulti. Never have owned Ulti. For those of you who have Ulti, it's dropping again. Are you doing your math? The question is, are you doing your math? Do you know with your Ulti, are you making money? You got your cost basis, you got your profit and loss on your cost basis, and then you got your reinvested money that you're putting back in there to get more dividends. Now, I know you're losing money on the NAV, but are your dividends significantly outperforming the loss on the Ulti, on the dividend? You got to track those two separately, and if you're not, you don't know what you're doing. And of course, you can go over to Portfolio Matrix, and it'll tell you if you got it in Portfolio Matrix. But a lot of guys don't have Portfolio Matrix, so I like to do both. I like to still maintain my spreadsheet just for you guys who want to have a copy of the spreadsheet. All this stuff for me is over in Portfolio Matrix, and I do the spreadsheet to try and give a little, it's a better lesson sometimes to come in here and show you how I'm doing it in the math and how the math is done. But I don't have Ulti and I don't have TSYY, so I can't go show you my numbers on those. But we can now pop over to, now what I want to do is just quickly go over to Portfolio Matrix, and we're going to see if I can get logged in. Okay, and now what I want to do is I want to go over to my reinvest. No, I want to go right here, invest underlying. No, I want to go to reinvest. So we got SNOI and VDY, Coney. What's the other ones we got? Okay, let's do AMDY, AMDY. So we're going to add AMTY to our reinvest. Add AMDY. Come on, buddy, pick up the speed. There we go. Now we can start moving. Okay, AMDY, SNOI, NVIDIA, Coney. So let me cross these out. We got AMDY. We got SNOI. SNOI. My pins are all dying, every single one of them. SNOI, NVIDIA. Cross off NVIDIA and Coney. So where's Coney? Coney. All right, so that means we got to put in OARK. So we're going to go OARK. So we're going to add OARK. So cross that one off. Next one is HOY. Let's go put in HOY. I thought I already had HOY. Nope. HOOY. Let's add HOOY. Next one is Misty, MSTY. Don't really want to add money to Misty. Ugh, look at this. Both of these are dropping like a rock. Gain is down 81. The yield is 105. Still making 23% annualized return. Who's going to complain about making 23% annualized return? I am. Why? Because I could make 80% somewhere else. All right. Get rid of the, well, Misty. Yeah, crossed off. HOY, we got it. NVIDIA, PLTY. Let's go put PLTY. PLTY. Look at that, 67% return. See, I could have my money in there instead of over at Misty. I could roll. You want to roll out? Not if Bitcoin has a good year in 2026. I won't. I wish I wouldn't have rolled out. That's why I'm holding on to the piece of doggy poop poop. I didn't say the bad word. I'm going to try not to. Oh, I already said one bad word, didn't I? I said scientific wild ass guess. I'm going to have to go to YouTube confessional anyway. So now I can do that. That piece of shit. I've already broken my rule anyway. All right, let's see. PLTY, add it, add PLTY. Okay, what's the next one? PLTY, TSLY. That's our last one. So we'll add TSLY. And look, well, look at that big drop right there. That's killing it. It's 29%, but that's with that nasty 55% loss off of here. But we haven't had that. We go to 6 months. What's the loss been over the 6 months gain? It's only been 5%. 5%. But over a year's period of growth, well, it's got that big lousy growth in there too. Go back to 6%. Yeah, 32%. 32% annualized return. No, that's 6% return. So that would be 6 month return. 6 month return. That'd be 32. That'd be 64% annualized return. You double that for a year. That's good. All right. So let's go over here now and let's go into our total portfolio. We don't need to see all this because there's no investment in it. So we're going to just see if we can go to targeter. So this is what we want to do. And I like relative performance, and we can, let's get rid of all these. Delete, 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 delete all. Okay. So now we got to reinvest, and we're going to put in here. I've got $10,000. It's not quite $10,000. It's like 9,700 and something, but we'll just put 10,000 for now. 10,000. Okay, we're going to do, I like relative performance. And right now we could do either price gain, dividend yield, combined gain plus yield, or most recent dividends. I think I want to do most recent dividends because I'm not really, I know that these markets are all going down. So if we do combined gain plus the dividends, it's going to take into consideration all these losing markets, which is why we're on our list, right? Because they're down below my average prices. So they're dipping. So I don't really care about the combined gain. I'm mostly interested in the most recent dividends. Now you could go dividend yield, sets targets using the annualized dividend yield percentages, but I don't really want that either because at the first of the year, the first 3-4 months of the year, we had nasty drops, right? So if we just went off of the most recent dividends, this would probably give me where I want to put my money. And based on that, you can see the percentage right here. We'll just go ahead and apply that. And it's telling me that I need to put in Tesla. I'm going to put 57% of my money. It likes Tesla. So equity, I'm going to put $1,500 in Tesla. I'm going to be putting $1,500 into Snowy, which I don't want to do. That's going to be a hard purchase right there. That's saying put money into stupid Bitcoin. Buy when there's blood in the street, land. It's only $1,500. Yes, but it's $1,500 that I could be putting somewhere else. That's going to be a painful purchase right there. NVIDIA, 1466. Okay, I'm going to be putting in Palantir 1400, in OARK I'm going to be putting 1,243, and in Coney I'm going to be putting 1,195. That's another painful one right there. I can tell you I don't want to put it into Coney. And then AMDY 1,000, then Hui. Oh, Hui's only 460. Well, that's probably okay because it's coming down pretty hard. All right, guys, that's it. We did all of our hard work. Now we know where to put our money. Those are the markets that I'm going to be reinvesting my dividends into, and that's how I do it. I used to do that once a month. Now I have to do it every week. And if you don't have Portfolio Matrix to do it with, it's going to be a real pain in the hiney to do it on your own. Okay, that's all I got for you. Sorry, did you talk about TSYY? I did a little bit. I mentioned TSYY only because I don't have it, and I showed my history on it. So Jay, I'll show you just real quick what I did do with it. I don't have any. I've only had it for a little while, so I'll show you my spreadsheet on that. So here's my TSYY right here. You can see I don't have any information other than I made $6,600 in dividends over the period of time which I held it this year so far in 2025. I don't know what I lost on the NAV. I would have to go put that in. I didn't track it. I stopped tracking it because I just didn't put it in. It's over. I could probably go find it in Portfolio Matrix if I went and really looked hard. But I don't have it in my spreadsheet. I don't have TSYY. TSYY is going to be basically the same as TSLY. So it's starting to TSLY, TSYY. You know, we got this nice bump in Tesla today. So you can see what it did in Tesla. TSYY had kind of it's a tiny little bump in TSYY because remember, TSYY doesn't make money from an increase in value of the stock. It doesn't participate in upside potential at all. Would it be worthy of investing in? We have a lot of students who are in it and are very happy with it. So I will say that. You could do the simple math. We can come into TSYY. We'll go look at it over in Portfolio Matrix real quick, and let's go look at it for you. Yes, we got a lot of people who are in this one. So let's go look at TSYY. Actually, we got to go back over to here. TSYY. So you can see that TSYY, the gain, this is the thing that I struggle with a little bit on TSYY. Let's go back a whole year. So an annualized gain, see it's down 74%, which is hard to watch happen to your money. But it has 128% annualized yield, even with this big nasty drop. So you can, this big nasty drop is part of that 74%. So it's really not quite that bad. So you're still making 53% annualized return. That's a lot of money. Yeah, the dividends, and it is the majority of my dividend holdings. I've just been collecting them. So it's making a lot of money for a lot of students. 53%. That's a lot of money. That's more than a lot of the ones I have. It's, in fact, I think it's more than TSLY, which is the one I have. TSLY. See, TSLY is only 30%. So TSYY is making a lot more money when you combine the gain and the yield than TSYY. But TSYY gets to participate in some of the upside potential if Tesla takes off and goes to the moon. So I think Tesla's going to take off and go to the moon. So I've been in anticipation of seeing that happen. I've been, kind of watching and seeing if that's going to happen for us. But you get to participate. You get to participate in the upside potential because of the way they trade their options on YieldMax versus Granite shares. Granite shares sells put options. And so put options is basically an insurance policy that the market's not going to fall, right? So if the market falls, well, you get to collect all that premium. But if the market does fall, you have to pay that premium out. YieldMax, on the other hand, does covered calls. So they get to participate in the upside growth of Tesla up to the level of which the covered call, and then they get the premium from the covered call. So we get that additional upside growth potential. So if you believe that the stock is going to rise, right, you might want to be in TSLY, which is why I'm in TSLY, because I think the stock's going to rise. But the thing is those put options are so expensive because of the volatility of TSY. That's why TSYY is doing so well, right? They're a huge amount of money coming back to you. The problem is I think they're doing a lot of ROCC in there. I think they're returning some of your cash and your capital because that net asset value just keeps falling. And so that means to me that they're returning to give you those eye-popping returns. They're giving you back some of your own capital, which is fine. I mean, they're going to have to do a reverse split on this thing pretty soon because they're down at $6 a share, and anything below $5 gets delisted. So they're going to have to do a reverse split here pretty soon. I mean, they're at $6. As long as they stay above $5, they're not going to have to do a reverse split. But YieldMax had to do a bunch of reverse splits recently because they were starting to drop below $5. And when you get drop below the $5, well, the exchange gets mad at you and they're going to delist you. So you have to stay above $5. Otherwise, you're going to go back to the penny stocks. So that's why they did a reverse split. Different strokes for different folks. Am I saying just because I don't have it that it's bad? No, I had it for a while and it made good money. I just couldn't. I just did a portfolio rebalance, and I had to make the decision whether I wanted to be in Tesla in anticipation of upside growth or if I just wanted to stay in the Granite shares. And at the time, I decided to go into TSLY. And would I have made more money if I'd have stayed in TSYY? Yeah, I would have. So there is that. So can't cry over spilt milk right now, though. But I think Tesla's proven that it's taken off and going to the moon. They've had some really good news. And hopefully the Granite shares, and hopefully the YieldMax version will catch up and do as well as the Granite shares version. I don't know. Might have to start putting some more money into Granite shares. I'd like to see them stop doing so much ROC, return of cash, return of capital. I wish they would take down some of their dividend. They just want that big eye-popping number, so they keep it up there by giving you back some of your own money, which is fine. I mean, nothing wrong with that. It's just they just keep lowering your cost of entry is what they do, so that your percent gain looks larger. It's still a smaller dollar amount, but it's a larger percent gain. Math, statistics, lies and damn lies. All right, guys, that's all I got for you. I'm gonna let you go. Go down and get some breakfast, and we will catch you here. I don't know when we're gonna do another class. Maybe Wednesday for let's shoot for Wednesday afternoon, and we'll do some day trading. And then we got some options. We can do some day trading with options. I just taught an options class, and we had fun options trading day trading with options. So we're going to do that Wednesday afternoon during power hour, which is 1 o'clock Mountain Standard Time, which would be 3 o'clock Eastern Time. So we'll do some day trading. And then if you guys have some more questions, you can raise some questions. We'll stick around afterwards a little bit and answer some questions. We'll do a little day trading with options Wednesday afternoon at 1 o'clock. How's that sound? Sound fun? All right, let's see. We got what else is Jay saying? The dividends is the majority of my dividend holding. I have just about collecting them. Yeah, that's what my wife does. She doesn't reinvest her dividends. She just goes and spends the money. She just uses it for income. Who thought of doing that? All right, guys, we'll catch you next time. We'll see you.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.